about that. This is the topic we're going to explore, the idea of how can we use simulation in portfolio management to help with the decision making at that level without using estimates. All right, I think we need to mute Oleg. He's hammering something, I guess.
All right.
Thank you. So the what if question is a very common question, right? Like in the no estimates debate, for example, a very common question I get is, okay, but what if you need to decide between 3 different projects, A, B, and C? Which one will you decide, and how can you do that without estimates? And it's a fair question, although the answer is quite easy. You do a little bit of all 3, and then you decide which one you think has the biggest upside, right? And that's what portfolio is there to do, to help us decide strategically what to invest more on and what to invest less on. And this brings us to the idea that risk management is very often done at portfolio level by using estimates. But you can only spend so much time estimating. And also, the moment you give the estimate, it's already out of date, because that's the moment when you start collecting more knowledge and not updating the estimate. So estimates are also a problem at portfolio level because they are not updated. Although you learn, the portfolio doesn't learn. And of course, that's countersensical. It makes no sense for us to know if a project is delivering more value or not, and not make any decisions based on that information. That is the opposite of agile. And unfortunately, and we will talk about that right now, many of the portfolios that we talk about, they are not really agile, right? Like, this is a project plan. This is the good old school project plan. You have the tasks here on the left, then you have the bars that denote the duration of each of those. You have the dependencies. I guess many of you are familiar with this. This is a Gantt chart, just as it says here, right? And this is what we used to use to manage waterfall projects. Well, unfortunately, it's still being used. These days, it's used for managing portfolios. This is a portfolio. You still see the biggest initiatives here, the duration, and you have the dependencies, and so on and so forth. So we are really still managing the portfolio with the same strategies and techniques that we used to use to manage waterfall projects. And this is even more worrying because a portfolio is the future of your organizations, right? Like, it's the important things that will affect how we develop the organization for the future. So how can we be using techniques like this that are already discredited, they are out of date, they are not correct if we want to be adaptable, if we want to adapt to information that is coming to us on a daily basis? So we need something different that focuses on outcomes. This is the product part of the talk, of course, and adaptability. And this is the agile part of the talk. Outcomes in this context means impact, right? Like that we are not just delivering code, we are delivering something that leads to a change in customer behavior and hopefully also a benefit for the company producing the product. That's what we talk about as outcomes. Perhaps one of the biggest problems was that when we managed projects the waterfall way, we are focusing on predictability. That was really the goal for most, and still is the goal for most project management strategies, including the way project managers manage risk. But here's the problem. Being predictable about delivering a product does not mean that we are predictable on the value that that product delivers. So at portfolio level, we need to start considering, is predictability really the focus we want to have? Or should we rather focus on the value that we create by investing in an overall portfolio of initiatives or projects And if you're talking about one product, that portfolio would be a number of features, right? Because features are being developed for a specific release or for a specific timeline. Those would be the things you're investing in with the hope of a return. So when we talk about multiple projects, the portfolio is all of those projects together. When we talk about one project, then we're talking about these features, which are the bets, right? We're betting that those features will return value to us as well as add value to the customer. So this leads us to the problem number 2 of this talk, and we will explore potential solutions for this in a second, which is that when we try to maximize predictability, this is what Waterfall did, we lose sight of the most important goal, which is maximize the value generated from the investment we have made. And this is an important thought that I want you to keep in your minds as we go through this talk. We should be focusing on maximizing value generated from the investment that is represented by the portfolio of features or the portfolio of projects that we are managing in the company. Now, there are many things that affect a project or a portfolio of projects. And there's one thing we have learned from complexity theory and the study of complexity is that if you have something, and in this example, we're talking about the Lorentz system, so we're talking about the weather, right? If you have something that is affected by multiple variables, you will very quickly get to a level of behavior that is complex. And this is an example, Edward Lorenz is, with the Lorentz system, demonstrated that you only need 3 variables to observe complex behavior in a system. 3 variables are enough. Now, it's very easy for you to think about 3, 10, 20 variables that affect the execution of one project, let alone several projects. So one of the things that we need to realize is that if what we are trying to do is to manage a portfolio of projects, we are very deep into the complex domain, i.e., predicting what will happen is not possible, except in very small, very limited environments and with very specific conditions. So we need to look for an alternative. And definitely because prediction is not possible, then we can say that estimation is useless when it comes to understanding and maximizing the value that comes out of a portfolio of projects or features that we are investing in. So that brings us problem number 3. Plans are static, but portfolio management requires us to have near real-time adaptation capabilities. Now, this is a big problem if you think about it. How can you get near real-time adaptation at a portfolio level when many of our teams aren't even able to do this at the team level, which is not as complex, although it is complex, it is not as complex as portfolio level. So that brings a very important, let's say, challenge or problem, which is, okay, so we need to generate near real-time actionable information, and then we need to have systems to make decisions at portfolio level that allow us to adapt to that information. This is what agility has always been about. We just haven't phrased it this way, right? We've talked about responding to change over following a plan. Well, that's all great and good when you're talking about one project, but when you go up to the portfolio level, it's not one plan. It's 5, 10, 20 different plans that are interacting with each other in ways that we cannot predict. But then there's a further level of complexity, which is the most important when the goal is to maximize value, and that is, but what happens in the market? Are the features we are delivering being accepted and welcomed by the market? Are they driving the behaviors we need to drive in order to maximize the value of the portfolio or not? So these layers of complexity and these levels of complexity are very important to understand. At portfolio level, the complexity of adaptation, of agility in the end, is much higher, and it requires different approaches than what we can do at the project level. All right, there's a lot more problems we could talk about related to traditional planning at portfolio level, but we'll focus on these three for now. And this is very important to understand. We're not going to go to the full level of depth that we could have. I'm just opening up Pandora's box a little bit just to show you how useful simulation can be, even when we are not going and exploring all possible levels of depth in what comes to managing a portfolio. So we have the problems here, and I want to call your attention to the characteristics that I have for each of the problems. So we need something different than project management and traditional portfolio management that focuses on outcomes and adaptability. And you will see the colors here, they are replicated here. And we need something that tries to maximize the value. That's another aspect that we need to focus on, and we have those characteristics here on the goals. And then we need near real-time outcome simulation so that we can then gather the insights that allow us to execute on that promise of adaptability. Because don't forget that agility has brought adaptability at the team level, at the project level, but we need to take that much further if we are to benefit from agility in an organization. Right, so this of course gives us a set of goals, right? So we need to visualize possible outcomes, and we need to do it in a way that can be easily understandable, that we can grasp and take that as input and make decisions. We need to simulate the outcomes because that's what matters, right? Outcomes is the value in the end. We need to simulate these outcomes in variables that the stakeholders care about and represent value for the organization. And this one is very important because we can't just simulate something very high level, like, for example, the release date. That's one thing we've been doing a long time with the adaptations around the not working estimates, for example. But it's not enough to simulate the release date. We need to simulate other things that the organization care about, right? And we'll talk about how to do that. And we need to provide near real-time outcome simulation that incorporates the information or the data at the time that we have it so that we can then adapt. And that's where the real agility comes from. Without number three, we can't have agility at portfolio level. And then finally, we need to build robustness or resilience into portfolio management. And this is what real risk management is all about, right? Risk management is very often understood as just predicting the risks and being ready for them. Yeah, that's important, but it's not even half the job. We need to actually be able to recover when certain risks do invariably happen over time. All right, so how do we do this, right? Like, how do we make this practical is the next question. So let's go through those. Let's start with the first goal, to visualize outcomes in an understandable way. Okay, so first thing that is very important is that we need to allow for multiple possible outcomes. When we used to do estimates, there was only one outcome, and that outcome was the release date, and it had typically one point. In some cases, it had like a window, but that window was never really updated. So it wasn't really useful, right? So we need to allow for multiple outcomes, and we need to talk about probabilities, right? So we can have outcome A, B, and C, and the probabilities are X, Y, and Z. We need to illustrate this probability in a very clear way that allows for decision making. We need to simulate in variables that the stakeholders care about and represent value for the organization. Something was lost here. I need to fix that. And we need to have the ability to process this information. We'll talk more about that in one of the later goals. And we need to avoid known biases. Now, all of those are too many. There's too much detail here. So let's translate this into something visual. Okay, so here's a simple outcome visualization where we only have two variables and they only have two values, right? This is an example of a very simple variable and outcome visualization. So if variable B is 0 and variable A is 0, that's about 3% probability. And then we can talk about 27% probability and 63% probability and so on. And what this basically means is this is a very easy way to visualize that the most likely outcome is when A is 1 and B is 1 because the area here is bigger, right? This is a very simple strategy to visualize two variables so that we can show, hey, if A and B happen, this is the most likely outcome. There's a probability of 63% that will happen, but there's still a 3% probability that not even A nor B will happen, right? So we can talk about probabilities, and that's very important because that feeds into the decision-making process for the portfolio. But it can get a lot more complicated, right? This is a three-dimensional visualization of a simulation. So we need to be careful with what we are presenting our stakeholders. Now, the cool thing about visualizing outcomes is that you need to focus on a small number of variables, and that allows you to clarify your strategy, right? Like, which variables do we care about? And that conversation alone will take you very far in understanding and crystallizing the strategy you have for your product or set of products. We're talking about portfolio, of course. And there's the other thing is that if you can visualize outcomes, you can simulate any project thousands of times, and you can easily get an understanding of what are the most likely outcomes. And this is very important. You can do the same for risks and so on. And this is when we talk about reducing the number of variables we talk about or discuss, because simulation, it's not easy when you have many variables that you care about. So you need to reduce the number of variables, and then you need to start visualizing those. And then you need to get there, you need to have a super crystal clear strategy. You need to have a super black and white definition of success. And in my experience, and there are many studies around that, having that clear definition of success is a huge enabler for teams to be agile themselves and to adapt to the information that they themselves, the teams, are collecting over time. This is a simple example that is taken out of the investment world, right? So if you think about an investment portfolio, you have a bunch of stocks, and then you calculate the likely outcome of your investment over time. And this is just an example. I won't go through all of the details, but this is a typical outcome of portfolio simulation. The value here that you care about is the Sharpe ratio, which tells you what is the value of your investment. And here you can see that there's a very large concentration around this. You should not need to be here in order to get value, and it's unlikely that you will be here either. So this is the most likely set of outcomes for you. And now based on that information, you can start to figure out, okay, is this the right portfolio for us, right? And as we simulate this, we will see these areas moving, and we will be able to assess what the things we care about, right? The many decisions we need to make, like, for example, do we start A, B, or C projects? Well, you can simulate that, and you can figure out over time what is the most likely outcome if you start A, if you start B, if you start C, or any combination of those three, right? And that's what we are talking about. If we can visualize the outcome of your projects, we can make decisions just like investment portfolio managers make today, based on information that is constantly being updated, simulated forward, and giving you an insight into the most likely outcomes. All right, before we go to goal 2, are there questions so far? All right, then we will be moving on. Now, goal 1 talks about the importance of visualizing the outcomes, because visualizing the outcomes allow us to incorporate information and make decisions quickly. But the variables in which we need to visualize the outcomes need to be variables that the stakeholders care about and also represent value for the organization. I already hinted at this when I talked about the importance of having a crystal clear strategy. So what we need to really do as a process of getting simulation just up and running is to have a conversation within the organization about our strategic goals, right? Like a lot of people are talking about OKRs, and I'm not against OKRs. I think that if used correctly, they can provide a lot of value to organizations. But unfortunately, very often OKRs end up being used as kind of a project management tool. That it's just a decomposition of work, which used to be called a work breakdown structure, that comes from the top to the bottom, and it basically assigns work to people within the organization. That's not why OKRs were created, nor is it where they can have an impact. But they can have an impact, just like simulation can, in helping you formalize and be crystal clear about what are your strategic goals. So in simulation, we talk about that, and we talk about what variables, given the strategic goals, what variables represent value, because those are the only ones that we want to simulate and visualize. Here are example variables that matter at portfolio level. We can talk about how many leads we have or get from a particular product or investment, the customers, the lifetime value of a customer, the profit itself, revenues, churn. These are variables that we care about. Now, you will notice that very often these variables are not talked about when we approve a project. In fact, very often when we approve a project at portfolio level, we talk about what are the features, who's going to be involved, how much does it cost, when is it going to be delivered. Those are all project management concerns. They are not value or strategic concerns. So we also need to change the mindset when it comes to discussing portfolio value, and we really need to bring these very important business metrics to the fore to be more important in our conversation. And with simulation, we start that from the beginning by analyzing and agreeing on what are the variables we care about, therefore contributing to that crystallization of the strategy and a much better definition of what success is, what value is. So in our company, we use a tool that we've developed for this conversation, which is called the business value equation, which tries to capture what value creation means for the companies that we work with. And it usually gives you the high-level critical business metrics that are linked to the overall performance, or in the case of startups, even the valuation of the company. So here's an example. Imagine that you own Amazon, the website, not the company, but the website, right? For Amazon, the website, the value they generate is, or can be measured in revenues. Let's assume it is for now. And the revenues of that website are a factor of the number of visits, the conversion rate to purchase, so how many of these end up purchasing, the average price of every purchase, so how many of these that purchase, what is the value that they usually purchase at, and then finally the repeat rate, so how many of these come back and buy again. And if you think about it, these are already 4 critical metrics that we can focus on at portfolio level and simulate based on the input, which is the set of ideas, projects, or features that we want to deliver over time. So the goal for us at portfolio management level is value creation. And if we think about it that way, then we need to crystal clear define what value is, so what variables we care about and represent value. And then we need to stop focusing on project execution. Because if you think about it, great portfolio management should be canceling features and projects on a regular basis. Just like when you invest in the stock market and you put money into a stock and the stock doesn't deliver what you expect, you stop putting money in that stock. You even sell the stock and get the money back and invest in some other stock. This is what investors do, portfolio management in investment. This is what they do every single day of the year. And we can learn a lot from that. You know what they don't focus on is on buying stocks at a specific date and selling them at a specific date that was predicted a year ago. That's not what they do. They have real-time information coming in and they're constantly adjusting their portfolio based on that information that is coming in. Right, before we go on to the next goal, any questions about the concepts that I've been presenting so far?
Maybe not a question, but a remark from my side. I found it striking when you just mentioned that business metrics are actually not part of planning. I mean, when we do like hypothesis-driven development, right? This is where we say we make a feature or something or product testable by whatever it means, right? Whichever metric we apply. But we don't do this in planning, that's right.
Yeah, at portfolio level, usually you don't do that. And even it goes even further. You start from the assumption that you already know exactly what needs to be done in order to achieve the strategic goals that you have defined. And you never question that again. In fact, most organizations only review their portfolio of projects once a year.
Yeah, maybe because why? Why do you think this is?
That is a good question. Why do organizations review their project portfolio and plan their project portfolio only once a year? I don't know. Why should they?
Christoph. Sorry, Vasco. Was it an open question to the?
No,
You want to answer yourself?
go ahead.
No. Didn't want to stop you. Christoph, you got your hand up.
Yeah. When you write this sentence, the goal of portfolio management is value creation, not project execution follow-up. Not sure if I understand it fully. What's going on in my head is the following thing, that can value creation always be independent of execution and timing? For example, renewable energies is, just as I was working lately with a customer with that, they are depending on, timing is very important for them. So they need to deliver certain things until a certain point of time, because legislation tells them, a new law comes in, and if we don't get it delivered until this point of time, it's very time critical, we don't create value, we cannot do or realize revenues. So is execution always independent of value creation?
Actually, that's a very good point. And let's take all regulated industries as an example, not the specific example you have. Like, for example, taxation software is a great example, right? Like if the taxation law changes at the end of the year, you have to get it ready, period, right? So there, project execution follow-up is important, but more important than that is, how are we doing it, and does it deliver the value we expect? So in the case of taxation software, which is a very easy case to understand, right? Like the law changes, your software needs to change, period, right? So when you have that kind of project, the question is not, what should we do? The question is, okay, what is the minimum we can do so that we are ready many months ahead of the deadline, so that we can use the rest of the time in order to find and use the legislation to our benefit, in order to find what else can we do that makes customers want to use our software instead of the competitor. Because here's the other side of externally imposed deadlines. All your competitors have the exact same deadline. They are all trying to hit the exact same deadline. So hitting the deadline doesn't give you any value or competitive advantage. So in the no estimates work, I've already tackled the how do you deliver on time. And the short of it is, you deliver way ahead of the time you think you need to deliver, because otherwise you're going to be late, period, right? Because the work always expands to fill the available time. So if you, like, I call this the Christmas problem. If you need to deliver in Christmas, let's say we start today, right? Mid-May, we start the project. We need to deliver in Christmas. How do you make sure you deliver in Christmas? That's very easy. You deliver in August. But how do you make sure you deliver in August? Well, that's very easy. You deliver in July. Well, but how do you make sure you deliver in July? Well, you deliver in June and so on. And eventually you get to what we already know, all of us who work in the agile field, is that you deliver every single day. And every single day you assess, have I reached the minimum that I need in order to say that I'm done? And that's how you tackle the fixed deadline problem. But I want to expand from that, because at portfolio level, you want to create value. So every day you deliver earlier than the deadline is one more day you can focus on adding value that makes you better than the competitors, right? And these are the key decisions we have at portfolio level. If we use no estimates, at least the way I defend it should be used, you're always going to deliver on time. Delivering on time is never the problem. The problem is what to deliver on time. And this is what I'm trying to talk about here, is that project execution follow-up should be given for free. It should be a given that we always deliver on time. Like, that's what I'm trying to say with the whole no estimates book work that I've done. Next step is, how do we maximize the value that we deliver to the customers, and of course that we get back in terms of return on investment? That is the key question.
Christoph's happy with the answer. I'm too. Thanks, Vasco.
All right. So let's do a quick review. So we talked about thinking about portfolio as an investment problem rather than a project follow-up problem. And we talked about how investors already simulate their portfolios and can get an overview of what are the most likely outcomes and make decisions on that. And now we talked about how we need to be crystal clear about the metrics that define success for us and for our business. Those are the variables we want to simulate, and to focus portfolio management on assessing how are we evolving in the value creation rather than in project execution. Those two are critical aspects for our talk today. Then the third, which builds on this, is that, okay, that's great, but how can we make decisions and incorporate that information? You know, how can we be agile? Right? It's not enough to be able to visualize information. It's not enough to say we're focusing on value creation with clear variables. We also need to be getting information in real time and updating our simulation. That's why simulation is so valuable, because you can run it like this. You can run project portfolio simulation thousands of times per minute. This is how powerful it is. Why aren't we using this capability, right? When we do run it, we do need to have good data coming in to use in the simulation. And that is driving us to be able to do real-time outcome simulation based on constantly updated sets of beliefs. I'll talk more about that in a second. And then being able to build the processes at portfolio level that incorporate that data and translate it into decisions. That's where the real agility is for us. And for that, we can already say that project estimation does not work. First of all, project estimation only really tackles a very small number of variables. If you include risk management, we are talking about a small number of variables. If you just talk about duration, it's just one variable, the duration, right? And that's not really what we deal with in reality. In reality, project portfolios are much more complex. They have a lot more variables that we need to simulate and understand the impact of a change in each of those in the outcomes for us. So the simulation allows us to build a system that incorporates these multiple sets of information and constantly updates our beliefs in the outcome of the projects, i.e. the portfolio, all of the projects together. So it helps us to take into account information and evaluate decisions that affect projects as well as value creation. This is what the whole what if part of the title of the talk is about. The what if is, for example, what if we take this one team to work on project B? What happens? What if we add this feature to the backlog? What if we try to integrate with service provider X? What if we hire an external company to come in and give us another team of development so that we can try to improve the either value delivery, speed of delivery, whatever is important for you at that time, right? This what if which is a very valid question, and we get loads of those all the time. This what if is what drives us to accept and realize that estimation doesn't really work, because, you know, if you get 4 or 5 what if questions in a week and you need to estimate to answer those, you're going to spend the whole week in estimation meetings, delivering no work at all. So this makes simulation a critical tool in our toolbox when it comes to focusing our portfolio on value. And the cool thing is that these days we even have systems that allow us to incorporate thousands of data points and generate real-time outcome simulations. So, for example, there's a group of researchers and scientists using generative AI to predict the path of hurricanes, right? So they're doing hurricane path simulation. And this is very important because the weather is a system that has, you know, thousands of variables, and it's very hard to do hurricane path simulation without a computer. And it's also very hard to do with the computer because of so many variables. But generative AI systems can take in a lot more variables and actually provide an outcome in a very short, these days, very short period of time. And that's what's really cool, and it's motivating and inspiring to be working with generative AI, because we are trying to assess how to use these systems to simulate a very complex system, the portfolio in your organization, and then bring out what are the most likely outcomes to inform the decision makers. So before I go forward, any questions so far? All right, so quick recap. We need to focus on simulating visually variables that the stakeholders care about. That's step 1. Step 2 is define those variables and focus on value creation. So change the processes at portfolio management to focus on value creation and decision making. And now we talked about how we can use existing systems already. This is not science fiction anymore, to simulate the outcomes when there are thousands of variables involved. Now, in our portfolio simulation, we don't do thousands of variables. We will use, 5, 10, whatever that is. But the point is that we can go much further. And as this generative AI technology develops and as we learn to work with it better, we can definitely go and incorporate a lot more variables in our simulation. And finally, goal number 4 is to build robustness or resilience into portfolio management. This is one of the goals of project management with what they call risk management. So risk management is there in order to provide robustness or resilience in the project context. And of course, at portfolio level, risk management is there to do the same. Unfortunately, the risk management that we have done so far is based on estimates, both of duration and effort, which is what I think doesn't work in any case, as well as many other variables. So how do we do it without doing that quote unquote estimate-driven risk management? Well, we need to build resilience into the portfolio from the ground up. The way we define portfolios needs to be rethought. And if you're interested in this, there's the Nassim Taleb's book, Anti-Fragile, which talks about how to look at risks in a way that is productive for you, i.e. where you can take advantage of risks in the best case. That's what anti-fragile is, or at least be resilient or robust to risks if they happen. And what he talks about is that we need to think about portfolios as sets of bets, and we need to look at it as an investor would look at a portfolio of investments, right? And that mindset totally changes how we look at project portfolios or feature portfolios if we talk about one specific product. So we need to explore the extremes. He talks about this barbell strategy. Explore the extremes, right? crazy ideas on one extreme, crazy ideas on the other extreme, simulate those, understand what are the impacts, because it is the outliers that have the biggest impact. And we know this intuitively from project delivery. We know that there is that one story, or that is that one architectural change that drives most of the delays in a project when a project is late. And we also know, and we have data for that, that is that one feature or that small number of features that drives most of the value for the products that we deliver. So this is the barbell strategy that Taleb talks about. And when we think about portfolios as investors, we need to start simulating these extreme barbell strategy ideas in order to assess their impact so that we can focus on those, right? And there's a lot of information already on the fact that most features don't deliver value or almost no value in products. So we need to be able to simulate so that we find those that are most likely to have an impact and deliver those instead. So that's one part, right? Building resilience by how we design portfolios in the first place. And then to make decisions under uncertainty, we use this concept of thinking in bets that Annie Duke describes in her book. We frame decisions as bets, and we start incorporating information that comes from that perspective. Let's say, for example, we're going out and watching a tennis game, right? And we make a bet with a friend. Like, I bet that, let's say, player A is going to make 20% unforced errors during the first set. And the other one, nah, this player is a lot more inconsistent. I think it can go up to even 50% of unforced errors. Okay, well, let's make a bet on that, right? And we are very intuitively familiar with that concept when it comes to sports, right? Will a football match have more or less than 10 corners? There are lots of sites out there that organize bets, even for these things, like how many corners will there be in a football match, right? So we're intuitively adept to using this thinking, but when we go to work, we forget about this. Well, what Annie Duke says is, when we think about decisions as bets, we are then ready to update our beliefs and therefore change our expectation of the outcomes, right? And that's what bets allow us to do. They allow us to think about decisions in terms of probabilities of outcomes. And once we have that in place, we can start to incorporate near real-time information to help us manage and reduce risk. So if in the tennis example that I just gave, let's say that, I bet that the player A is going to do only 20% of unforced errors, but let's say Sebastian bet that the player A was going to do 50% or more of unforced errors, and we're only through the first two games, and he's already at, let's say, 35% of unforced errors in all of the plays that have been there. I'm starting to feel less confident in my prediction, and now Sebastian is feeling more confident in his prediction. And that level of confidence is very important information when making decisions. So let's use bets in order to discuss decisions. I believe that something, therefore I bet that, and then you decide, you describe the decision you support. And that discussion, the belief that leads to the bet, is very important. And also, in very advanced cases, you can use betting markets, so you can incorporate decisions from the people within the projects in order to understand how is the project progressing and is it likely to deliver what you need to deliver. The other aspect of thinking about portfolios as investments is that we can use strategies that are already quite well established in the investment world that are designed to avoid ruin, i.e. catastrophic problems in delivering a project or a set of projects. That strategy is called the Kelly criterion, and it basically tells us how much should you invest into a project if it's not delivering on what you expected it to deliver. Right? So let's say you start 5 projects and they're all going along, and every now and then you review how close are we to the target on each of these 5. And for those projects that are less close to the target, so further away from the target, you start reducing the investment. And this is counterintuitive because in fact, in most portfolios, we have the opposite. When a project is late, we start putting more money into it, and it's like, Okay, that's called the sunk cost fallacy, right? Like we've already invested so much, we should put more money into it. No, at some point you should stop investing into it. There's no point in throwing good money after bad money, right? So Kelly criterion is already a very well established strategy to manage investment portfolios that we could start using already. It's already defined, it's already proven, it's there, and we could start using that to manage our investment portfolios when it comes to projects or features for a product. I will skip this last two because they are not so critical. I think the important point here is to help us think like investors, right? That to use simulation just like investors use simulation to assess likely outcomes. And I think I want to focus on, remember that when it comes to portfolio management, if we want to be agile at portfolio level, we need to build in the feedback and adaptation cycles. Simulation feeds into the feedback cycle, right? It gives you feedback about what are the likely outcomes, but then we need to come in and change the portfolio management decisions and cycles and processes to achieve that adaptation cycle, right? Simulation is not enough. We also need to change how we look at portfolios, what type of decisions we make, what type of decisions we consider important to make, and of course, how we go about making those decisions. Now, there's a lot of questions after a talk like this, which is more kind of inspiration and thinking about new ideas. All right, how do we do it in practice? What should we take into account? How do we generate data for the simulation? And what does the simulation process itself look like? These are all valid questions that we can't answer in one hour talk. So I think that what is important for you to get started after this talk is define the outcomes of interest, right? These are the variables we want to visualize. And that's a good place to start. If you have that conversation alone, you're going to help the whole organization move forward. What variables do we care about? And by the way, it can't be only on-time delivery. It has to be something else as well. And we need to manage portfolios for those other variables. Now, then you can collect and value each bet in the portfolio based on the beliefs that justify them. And here, a very simple way to start is, what are the beliefs that justify us choosing these projects? Just start with that question, right? What do we believe to be true? And then regularly come back and review. Is this still true? Is this still true? And then adapt based on that. That's a very simple way to get started. Now, if you want to go further, if you want to make it more complex, we can define a simulation algorithm. We can use Monte Carlo simulation. And of course, we can build the simulation runs into execution, the execution of the projects, to create the feedback and adaptation cycle for decisions, right? But if you do the first two, you're already much further ahead than most portfolio managers out there in the world today. Right? So let's stay realistic. Let's take one step at a time and move forward once we have those first steps defined. So a big thank you to Dan Vacanti, who was part of preparing this presentation. That's a screenshot I took of him when we were working on it. So thank you, Dan, as well, for contributing. And if you want to talk more about this, if you want to understand how this could be applied in your context, we can have a quick call, right? No strings attached. Let's just have a 30-minute call. The link is here on the QR code, but you can also just email me. And if you want the slides, you can also email me and I can send the slides to you. And we can talk about, okay, so what would this mean in my context? How would I apply? Where would I start? How do I get this thinking into the organization that I work for?
Vasco, thank you. So now it's time for Q&A. I would say it's close to 6. Let's maybe exceed till 6:05, expectation management, because I think there's going to be some questions. Who has one? Who has one question? Otherwise, Winnie?
Yes. Thank you, Sebastian. Vasco, thank you for your talk. My question is, I am curious, when you introduce this concept or this idea, what has been challenging and what behaviors that you usually need to shift?
Yeah, that's a very good question. And obviously, we can see you're a change agent because that's exactly the question that a change agent would ask. So the most important thing and also the hardest thing is to accept that there isn't a black and white outcome for a portfolio, right? Like the same for a project. We don't deliver exactly before or after the deadline. There's a bunch of possible outcomes. We can deliver before the deadline with the wrong kind of features. We can deliver before the deadline with the right kind of features. We can deliver before the deadline but not have the deployment team ready, so therefore we can't actually deliver any value. We can deliver after the deadline with all of the previous variables. There's so many things to think about. And very often the way we do it in project management is that we use risk management as kind of a replacement for thinking about probabilities. And what I'm talking about here is to stop thinking about risk management as, oh, what if A happens, what do we do? No, start using risk management as a way to explore the future possible outcomes and to be ready for them. Of course, we then need to talk about mitigation strategies or even avoidance strategies. That would be much better because you want to remove certain class of risks. For example, if you use no estimates, you're going to deliver on time. That stops being a risk. But what else? What are the other risks? And I think that the ability to think in probabilities of outcomes is very, very hard to come to bring to the corporate world. Now, the same people that I talk to about this, they might place a bet on a football match or a tennis match right there, right? Like right after the session we have, and they're having struggles understanding how to think in probabilities. But then, that evening they might make a bet on, is Bayern Munich going to win the Champions League? Now we know they won't because they lost to Real Madrid. So that's a given fact. But is Borussia going to win the Champions League? That's a bet. We don't know. What's the probability? Well, let's think about it, right? And I think that's the biggest mind shift. That's why I recommend the book by Annie Duke, because she really brings together this idea of thinking in probabilities and decision making, right? So Thinking in Bets is the book. I think this is a great resource to kind of bring that conversation up, and also to help us as change agents to think about what questions can I bring to the conversation that allows people to express their intuitive understanding of probabilities, because it does take quite a lot of intellectual effort to remove probabilities from our thinking because they are everywhere.
Thank you.
All right, Vasco, I'm curious. Oh, some more. I don't wanna like jump the line, but I'm curious about your experiences. Where did you or a success story or like a success moment where you found that your ideas do something better to the world?
All right, so if we're talking about simulation, which I expect is what you're referring to. So one of the things that we do in our company, for example, is that we don't work on projects, we work on experiments. And what is an experiment, right? An experiment is set up so that there's a belief stated about what we do and what the impact of that is. And one rule that we have in the company is that you should always get an experiment to production in 24 hours or less. Now, it may take more time to collect enough data to get a conclusion, but you should always take an experiment into production in 24 hours or less. And what that gives us is that cycle of adaptation based on real-time information that I'm talking about here in this simulation talk. If you take that to a much higher level, let's say managing, a company of 300 people with 10 projects going on at any given time, then the conversation is slightly different because you can't necessarily have that conversation on a daily level. So what we do is we bring that conversation up one layer to the portfolio level, and we say, okay, so instead of saying these are the projects I want to do next year, let's say, what do we expect these projects to prove within the next month? And then next month we review, are they likely to deliver that which we expected last month? And we update the beliefs. This is very important, this updating the beliefs, right? Because 1 month later you have more information. There are different things you believe in now. And updating the beliefs allow us to start using Monte Carlo simulation, using Bayesian, right? Bayesian logic and Bayesian thinking. We start understanding, okay, so if these beliefs change, how does that affect the prior? So the probability of certain outcomes has changed. Let's run the simulation and see what is the likelihood of outcome. So it really starts from that very simple thinking of, okay, so what do I expect if I do this today will happen tomorrow or within a week, right? That's how the thinking starts. And then we start thinking, okay, but how do you apply that to a portfolio level, which has, of course, much larger timelines because you need to deploy decisions into an organization, right? You don't make a decision today and it's in practice tomorrow. It might take a week or 2 weeks or even longer. But what we want to avoid is what is right there right now, which is this thinking of projects as kind of a Gantt chart at the portfolio level, right? We do project A and it goes to the end, and then once A is done, we start project B and then it goes to the end. And that's just like creating waterfall at the portfolio level. So that's what we want to avoid.
So first thing, mind shift on the portfolio level so that you start thinking in experiments instead of fixed.
Well, I wouldn't say that's the first step. I would say that the first step is to discuss what are the variables we care about, right? So do we care about, for example, lifetime value? Do we care about visits to a certain web page? Do we care about conversion rates in a certain product? What do we care about? And then assessing the impact of our decisions on those variables, right? And that can be done through conversation and then hopefully also through collecting metrics and evaluating that. But that's the idea. Once that is in place, then we can start talking about experiments.
Cool, thanks. All right, everybody, I think we have time for one quick question, if there's one. Vasco, shall we call it a day?
Well, it's been a pleasure to talk to you. I would say that like one last piece of advice from me is continue to think of ways to bring agility to the organization where we are, where you are. I think that's the key message. And simulation is one way to do that. But as I said before, we don't even need to start there. We can start with a much smaller step, which is think of the variables you care about and start discussing probabilities within the decisions that you are already making anyway.
Cool. Oh, awesome talk. Says it also in the chat. Thank you so much for having you. It was really cool. It was really insightful, and I think there's more to read than I could ever read. It's so interesting. So everybody scan the barcode if you haven't yet, and we are gonna share. We're gonna put the talk online. And Vasco, maybe also think about sharing the slides. Okay, so go back to the LinkedIn profile and check it out in a couple of days' time. Vasco, thanks. Everybody else, thank you. Have a nice evening.
All right, enjoy. Have a nice evening, everybody.